Every financial plan on Earth rests on one unchallenged assumption. The US dollar will remain the world's money. It is the ultimate too-big-to-fail asset. But history shows reserve currencies don't gently fade, they fracture. And the cracks forming in 2024 are tracing the exact blueprint of every prior collapse, from the Spanish doubloon to the British pound. The numbers are stark. Research by economists like Barry Eichengreen shows the average lifespan of a global reserve currency is roughly 94 years. The US dollar has held that title for 80. The British pound's final collapse didn't begin with a world war, but with a loss of fiscal credibility, a slow-motion crisis that unfolded decisively over 36 months between 1925 and 1931, culminating in its forced exit from the gold standard. We obsess over stock tickers, bond yields, and crypto prices. Yet the most critical chart, the US share of global foreign exchange reserves, has been in a silent 20-year bear market, declining from 71% to 59%. This decline isn't a smooth, manageable glide. It's a slowly building geologic pressure that, history tells us, eventually reaches a non-negotiable tipping point. This raises the defining question, what does that modern tipping point actually look like? Not a single day of panic on CNN, but a precise 3-year sequence where the world's financial plumbing is forcibly rewired in real time. This timeline doesn't start with a geopolitical explosion. It starts with a more mundane yet profoundly symbolic event, a failed US Treasury auction. That auction isn't a random accident. It is the mathematically predictable outcome of 3 converging crises set to reach critical mass in 2025. The dollar's collapse is not an act of God, but the result of 3 structural pillars cracking simultaneously. Pillar 1, the fiscal doom loop. The Congressional Budget Office projects U.S. public debt will hit 130% of GDP within a decade, on an inexorably rising path. The critical issue is not the absolute level, but the perception of an unstoppable trajectory. When foreign creditors who finance these deficits observe persistent deficits exceeding 5% of GDP during a period of economic growth and relative peace, they rationally question the political will to ever correct course. The faith in American fiscal governance erodes. Pillar 2, the loss of monetary credibility. The Federal Reserve's dismissal of 2021 inflation as transitory, followed by its most aggressive hiking cycle in decades, inflicted lasting damage. It revealed fallibility. Furthermore, the 2023 banking crisis and the Emergency Bank Term Funding Program, BTFP, showcased the Fed not as an independent guardian of value, but as an active, permanent market participant compelled to backstop its own financial system. Credibility, once lost, is nearly impossible to restore. Pillar 3, the geopolitical weaponization trap. The 2022 freezing of Russia's dollar reserves was a historic watershed. It demonstrated to every nation outside the Western alliance that their dollar holdings are not neutral financial assets, but potential political liabilities. In response, China, Saudi Arabia, India, and the expanding BRICS Plus bloc are actively executing a long-discussed plan, building alternative payment systems, promoting local currency trade, and diversifying reserves away from dollars, a process accelerated from theory into urgent practice. The convergence of these 3 in 2025 creates a vicious feedback loop. High deficits require constant foreign buying. Geopolitical distrust systematically reduces the pool of willing buyers. To bridge the gap, the Federal Reserve may be forced to monetize more debt directly or indirectly, further undermining the dollar's value and monetary credibility, which in turn incentivizes even faster diversification by foreign holders. The documented narrative of enduring U.S. financial supremacy clashes with this verified decay across all foundational pillars. The first domino does not fall with a declaration in Washington. It falls silently at a normally routine, but now intensely scrutinized, event. A quarterly U.S. Treasury refunding auction, where the world's demand for American debt is put to a real-time public test. In the second quarter of 2025, the catalyst arrives. The U.S. Treasury Department holds a routine auction for X billion dollars in 10-year notes. The results are not routine. The bid-to-cover ratio, measuring demand against supply, registers a shocking multi-year low. Primary dealers, the banks obligated to absorb unsold debt, are left holding an unusually large unwanted block. The yield, which moves inversely to price, spikes intraday by 25 basis points or more in a violent repricing. The auction fails, not due to a U.S. recession, but because the foundation of foreign demand has eroded. Traditional large buyers like Japan and China are no longer net accumulators. They may be net sellers to defend their own currencies or execute deliberate diversification. New buyers, if they exist, demand a significantly higher yield, a fiscal risk premium, to compensate for America's perceived political dysfunction and debt trajectory. The market realizes with sudden clarity that the only reliable price-insensitive buyer left is the Federal Reserve itself. The immediate reaction is electric. Financial headlines blare. The dollar index, DXY, plunges 2% in a single session. But the true signal of systemic danger is elsewhere. In the clandestine world of central bank swap lines, global commercial banks, now anxious about accessing dollar funding, make heavy, visible drawings on the Federal Reserve's standing swap facilities with other central banks. This surge signals acute stress in the global plumbing that distributes dollars, a modern-day bank run unfolding between institutions. This event is the Lehman moment for dollar credibility. It is not the failure of a bank, but the failure of price discovery in the world's benchmark safe asset. The mechanism for financing the American state has stuttered in plain sight. The documented belief in infinite demand for U.S. debt at any price collides with the verified historical precedent that demand is ultimately contingent on unshakable confidence, not yield alone. The failed auction is merely the visible symptom. The disease of distrust is now metastatic. Phase 2 involves a coordinated, quiet exit by the very institutions designed to be the bedrock holders of dollars. Following the failed auction, Phase 2 unfolds not with a bang, but with a silent, bureaucratic exodus. Central banks don't panic, they execute. Long-drafted diversification mandates, previously on a slow glide path, are shifted to an accelerated timetable. The goal is not to crash the Treasury market, but to methodically reduce exposure. This quiet run manifests in 3 concrete channels. First, accelerated gold accumulation. Central banks become relentless, unemotional buyers of physical bullion, the ultimate asset with no counterparty or political risk. Second, strategic allocation to Chinese government bonds, facilitated by opened financial channels like the Bond Connect program, representing a direct, deliberate shift into a rival geopolitical bloc's debt. Third, support for a new IMF special drawing rights, SDR-based basket, promoted as a neutral, multilateral alternative to any single nation's currency. The data trail published with a lag by the IMF would reveal the USD's share of global reserves falling from 59% to 55% within 18 months, a pace of decline unseen since the collapse of the Bretton Woods system in the 1970s. Concurrently, the U.S. Treasury's own TIC data would show persistent net foreign selling of treasuries. The most powerful blow is symbolic. Saudi Arabia, in a move that shatters a 50-year cornerstone of dollar dominance, announces a pilot program to price a portion of its oil sales to China in yuan, with a gold convertibility clause facilitated by the Shanghai Gold Exchange. While the initial economic volume may be small, the psychological impact is seismic. The petrodollar's monopoly is broken. The Federal Reserve's response is a trap to prevent a disorderly surge in Treasury yields that would cripple the U.S. government's financing ability. It is forced to explicitly cap long-term rates via yield curve control, YCC. This policy is the final, naked surrender of its inflation-fighting credibility. It announces to the world that the dollar's value will now be directly managed to facilitate government borrowing, not preserved for international savers or trade. This phase is not dramatic. It is deliberate and institutional. The dollar isn't crashing. It is being systematically replaced in the vaults of the world's most important financial institutions. Global dollar liquidity is slowly, intentionally drained from the system. And as that liquidity evaporates, the volatility of everyday international transactions spikes uncontrollably, moving the crisis from central bank balance sheets directly onto the screens of every multinational CFO and commodity trader on the planet. By the first quarter of 2027, the crisis moves from the realm of finance ministers to corporate boardrooms. With the dollar index, DXY, experiencing wild, politically driven monthly swings of plump 5%, the transactional cost of using dollars becomes unbearable. For a German manufacturer contracting to buy Indonesian nickel for delivery in 6 months, the currency risk now dwarfs the commodity price risk. The dollar is no longer a stable medium of exchange. It is the primary source of volatility. The rational corporate response is transactional abandonment. Major trading partners bypass the dollar entirely. China and Brazil settle soy and iron ore trades directly in yuan, reais, via prearranged swap lines. India and Saudi Arabia pilot a digital rupee-rial corridor for oil payments. Corporations increasingly demand contracts denominated in local currencies, euros, or, critically, in nascent neutral digital baskets. The dollar is surgically removed from commercial supply chains. This triggers a liquidity death spiral. The dollar's core advantage has been the immense, deep liquidity that makes transactions cheap and easy. As transaction volumes migrate to other channels, that liquidity pool shrinks. Lower liquidity leads to even wider bid-ask spreads and higher volatility for those still using dollars, which in turn makes the alternatives even more attractive. The powerful network effect that built dollar dominance now operates in vicious reverse. A pivotal case study is China's digital yuan, eCNY. Initially a domestic tool, it is strategically rolled out in special economic zones dedicated to commodity settlement. Its programmability allows for instant final settlement without the need for the traditional correspondent banking network, a system that is both sanctions-proof and avoids dollar intermediation. It doesn't need to be better than the dollar. It merely needs to be a good enough, less risky alternative for nations and corporations seeking autonomy. The documented view of the dollar as the permanent, irreplaceable vehicle of global trade shatters against the verified reality that transactional convenience is the first casualty of volatility. The financial and commercial worlds now actively adapt to a dollar-optional reality. The final, most painful phase is the violent adjustment this forces upon the insulated American economy itself. Phase 4 brings the crisis home. The collapse of dollar privilege triggers a brutal imported stagflation within the United States itself. The mechanism is the end of the exorbitant privilege. For decades, the U.S. exported dollars, effectively IOUs, and imported real goods, living beyond its productive means. As the world refuses to accumulate more IOUs, the dollar's value falls sharply. This makes imports of energy, manufactured goods, and food violently expensive, creating instant, structurally entrenched inflation that the Federal Reserve cannot control through domestic policy. This creates an interest rate doom loop. To defend the currency's free fall and combat runaway import inflation, the Fed is forced to raise interest rates aggressively. However, with public debt exceeding 130% of GDP, each 1% increase in rates adds hundreds of billions of dollars to the annual deficit, as calculated by the Congressional Budget Office. This worsens the very fiscal picture that eroded confidence in the first place. The Fed is trapped. Hiking rates to save the currency deepens the fiscal hole, while not hiking guarantees hyperinflation. The consequence is a historic compression of living standards. Real wages plummet as price inflation, driven by the cost of everything imported, radically outpaces income growth. As a net importer, the United States suffers a severe terms of trade shock, becoming markedly poorer in real global purchasing power. The wealth effect of the 2020s asset bubble inverts into a poverty effect driven by currency depreciation. The political and social fallout is catastrophic. Austerity, cutting spending, and raising taxes becomes mathematically inevitable but politically impossible, leading to legislative paralysis. The funding crises for Social Security and Medicare arrive decades early. The social contract frays under the pressure of evaporating real incomes and evaporating public services. This domestic turmoil is not a side effect. It is the core manifestation of a reserve currency collapse, a severe, irreversible decline in a nation's internal purchasing power and political cohesion. The closest historical parallel is the United Kingdom post-1945. The British Empire did not end with a revolutionary war. It ended with a series of grinding sterling crises that made the country poorer, forcing a retreat from global commitments and a decades-long reduction in geopolitical influence. The United States now faces a digital, accelerated version of this decline, where financial markets enforce austerity far more swiftly than any foreign power ever could. The documented American economic debate centered on growth versus recession becomes instantly obsolete. It is superseded by the verified incoming reality of a currency crisis, a more fundamental and devastating force that redefines the nation's economic destiny. The timeline concludes not with the clean ascension of a new global currency, but with a fragmented, unstable, multipolar monetary system. Understanding this chaotic end state is the key to navigating the turbulent years that will define it. The aftermath of the dollar's decline is not a new hegemony, but a fragmented, multipolar monetary world by 2028. No single hegemon emerges. The world does not anoint the Chinese yuan or a global digital currency as the sole successor. Instead, it fractures into competing currency blocks. A digital yuan bloc, anchored by China and the expanded BRICS Plus alliance, a diminished but cohesive Eurozone bloc, and a shrunken dollar bloc consisting of North America and its closest military allies. Trade and finance regionalize, becoming less efficient but more politically secure. The rise of synthetic reserve assets. To facilitate transactions between these distrustful blocs, a neutral intermediary layer emerges. The IMF's special drawing right, SDR basket, is reformed and supercharged, potentially augmented with gold and issued on a digital platform. It becomes the preferred unit of account for international institutions like the IMF and World Bank, and a neutral settlement layer for clearing transactions between the dollar, euro, and yuan blocks, minimizing direct exposure. Gold's resurgence as the ultimate arbiter. In this environment of distrust, gold undergoes a renaissance. It transcends its role as a mere asset to become the ultimate settlement asset of last resort between central banks. Gold reserves provide the tangible, non-political backing that lends credibility to the new synthetic systems and bilateral agreements, serving as the bedrock of trust in a trustless system. The new rules of finance. This multipolar system is inherently less stable and more expensive. Trade becomes more regional and bilateral. Capital controls reemerge as standard policy tools to manage volatile flows. The era of seamless, dollar-based global finance, with its deep liquidity and low transaction costs, is over, replaced by a patchwork of competing systems defined by geopolitical loyalty as much as by economics. The documented expectation of a linear transition to a single new global leader, like the dollar replacing the pound, is a fallacy. Verified history shows that after a hegemonic currency's decline, the system tends towards monetary fragmentation and competing blocs, as seen in the interwar period. This timeline is not inevitable fate, but a projection of current accelerating vectors. Changing the trajectory requires first correctly diagnosing the problem not as a cyclical downturn, but as a structural terminal decline of an economic order. The dollar's collapse timeline is not random. It is the playing out of three inexorable economic and political laws. First, Triffin's dilemma. Articulated by economist Robert Triffin in 1960, it states that to supply the world with the dollar liquidity needed for trade and reserves, the United States must run persistent current account deficits. But these very deficits, over time, erode confidence in the dollar's value. The U.S. is now at the terminal end stage of this dilemma, where the need to finance its deficits collides head-on with the world's dwindling appetite to finance them. As Triffin warned Congress, the United States can neither devalue its currency nor allow it to appreciate, without causing serious international monetary upheaval. The trap was set 6 decades ago. Second, network effects and lock-in. The dollar's dominance functions like a global language or an operating system. Its value grows with each additional user. This creates immense inertia. However, once a critical mass of key users, major trading nations, central banks, begin switching to an alternative due to perceived risk or cost, the network effect reverses. The 2025-2027 window in our timeline represents that critical mass tipping point, where abandonment becomes self-reinforcing and rapid. Third, Cohen's geopolitical theory of currency. Political scientist Benjamin Cohen argues currency power rests on 4 pillars: economic size, deep and open financial markets, political stability, and military reach to enforce the system. The United States retains the first and last, but is visibly losing the third, political stability, and its use of military diplomatic power to enforce financial compliance, sanctions, is actively undermining the second by motivating the creation of alternative, fragmented financial networks. These models collectively demonstrate why a soft landing or managed decline for the dollar is a political fantasy. The collapse is a discrete, nonlinear event preceded by a long, visible incubation period. The warning signs, the Triffin deficits, the eroding network loyalty, and the self-sabotage of currency power are flashing in real-time data today. What makes the 2025-2027 timeline plausible, even fast, is not economics alone, but technology. The shift from sterling to dollar played out over 30 years via telegraph and paper ledgers. Today, digital trading platforms, the central bank, digital currencies, CBDCs, and encrypted instant messaging allow for coordinated systemic shifts at the speed of light. The technological infrastructure for a rapid exit now exists, turning a generational process into a potential overnight event. The parallels are not theoretical. They are observable in 2024 data. Central bank gold buying. At record 50-year highs, a clear physical vote against purely financial assets. BRICS expansion and institutional muscle. While not yet creating a liquid alternative, the bloc is methodically building the legal and financial frameworks for non-dollar trade. U.S. fiscal impasse, repeated debt ceiling crises, and the absence of a credible long-term fiscal plan signal to the world a profound political inability to correct course, validating worst-case deficit projections. Live de-dollarization case studies. Iran and Russia are operating real-time, if painful, blueprints for how to conduct international trade outside the dollar and Western banking systems, providing lessons for other nations. The critical threshold is not about absolute size. The shift will not occur the moment China's GDP overtakes America's. It will occur when the perceived cost of holding dollars, encompassing financial risk, devaluation, political risk, sanctions, freezes, and opportunity cost, missing better yields elsewhere, exceeds the cost and friction of switching. This calculation is not static. It changes with every U.S. political crisis that highlights dysfunction, every spike in long-term Treasury yields that signals debt fears, and every successful pilot of a digital yuan for commodity settlement that lowers the switching cost for others. The documented mainstream dismissal of de-dollarization as impossible due to a lack of alternative is dangerously myopic. The verified reality is the deliberate, simultaneous construction of multiple partial alternatives, gold, digital currencies, bilateral corridors, expanded SDRs that collectively erode the dollar's margin of safety and monopolistic network benefits. For an investor, citizen, or policymaker, this is no longer an academic discussion. It demands a new, practical set of rules for preserving capital and navigating a fundamentally changing monetary landscape. The dollar's decline is not a binary event, but a 3-year process of systemic rewiring. The 2025-2027 window is where slow, decades-long trends catalyze into fast, irreversible facts. Navigating this requires a new resilience framework. 1. Geographic diversification. Treat currency blocks as you would asset classes. Legally and prudently hold assets, bank accounts, investments, property, in jurisdictions likely to anchor different monetary zones, e.g., North America, the Eurozone, Singapore to Asia. 2. Asset diversification with a tangible core. Allocate to assets with intrinsic utility beyond financial claims, productive agricultural land, renewable energy infrastructure, shares in critical commodity producers. Gold is a monetary hedge, not a speculative bet. 3. Currency hedging as core strategy. Abandon the mindset that the USD is cash. It is one volatile currency among many. Utilize funds that actively hedge currency exposure. Consider strategic allocations to currencies of nations with structural trade surpluses, commodity wealth, or relatively sound fiscal trajectories. 4. Skills over paper. The ultimate hedge is human capital. Invest in skills, networks, and relationships that hold value irrespective of the medium of exchange. Skills in healthcare, engineering, logistics, and local community building. The final verified insight is this. The IMF's COFR data, tracking the dollar's share of global reserves, is the single most important chart. When the USD share breaks decisively below 55%, the managed glide path becomes an uncontrolled dive. Monitor it quarterly as the ultimate bellwether. Your call to action is dual. Civically, pressure policymakers to treat fiscal sustainability not as a moral debate, but as the paramount national security imperative for preserving currency stability. Personally, conduct a rigorous dollar dependency audit of your net worth. What fractures? If the dollar loses 30% of its external purchasing power in 3 years. The dollar will not become worthless. It will become ordinary, just another fiat currency battling inflation and capital flight. But for a nation that has built its empire and standard of living on the exorbitant privilege of printing the world's money, ordinary will feel, economically and psychologically, like collapse.